The jobs report was an absolute disaster. President Trump immediately fired the head of the BLS, the Bureau of Labor Statistics, and gold has rallied since. Why? Well, the Fed seems to be cutting rates in September. It has to now. 85% chance of a rate cut in September. What is priced in? Is gold already topping out? We are speaking with Alasdair Macleod. You should know him. He's the head of he's the founder, publisher, and brain behind Macleod Finance Substack. You should definitely go check that out. Really, really worth your while. But before I switch over to my guest, hit that like and subscribe button. It helps us out tremendously, bringing phenomenal guests like Alasdair onto the program. Alasdair, it's great to see you again. Thanks so much for joining us.
Thank you for having me.
Yeah, I mentioned it in my intro. We have lots to sort of dissect here a little bit, Alasdair. Let's start with the reaction of gold to a bit of a hawkish Powell last week, Wednesday. I was personally surprised that gold reacted as much as it did to the Fed announcement and then the press conference. What do you make of that? Let's start there.
Well, I mean, this problem, if you like, with interest rates has become intensely political. And I think Powell is in a very difficult position. Obviously, the jobs report that came out, I mean, it's slightly ironic that it's the one thing, perhaps, which Trump would have wanted to persuade Powell that he should cut rates. And he goes and sacks the chief statistician. I mean, talk about shooting the messenger. It's, this is crazy, absolutely crazy. But it is essentially become very, very political. I think if I was in Powell's shoes, I would be worried about signs of inflation. If you look at what's been happening to metal prices, oil prices, agricultural prices, they're not going lower. If anything, they're tending to drift higher, measured in dollars. And that is even before there's any real impact from all this messing around with tariffs. And I just think that, if I was in Powell's position, I would not cut interest rates. But I think those job figures actually makes that policy almost untenable. Again, if I was in his shoes, I'd probably go a quarter point cut. And then in the script, if you like, the post-cut FOMC script, I would express all my concerns about inflation and all the rest of it. And just get the message over that it's okay, it's a quarter point now, but that's it for the foreseeable future. So I think that's what we're going to get. As to how gold is behaving, I think we have to appreciate that, we're in this sort of summer lull. I mean, people are on the beaches or they're with their kids who are on holiday or whatever. This always happens, actually, every summer. And talking to other, sort of friends, if you like, in the Substack community, they tell me that, things quieten down in the summer, which I think actually says it all. So nobody's really sitting there and thinking too hard about the implications of what's going on. I guess that in the coming weeks, I mean, particularly in early September, this is what usually happens. In early September, people return from their holidays, investment managers begin to have the committee meetings and all the rest of it. And, the investment strategists in these big firms, start considering the position seriously. And then you find that investment decisions begin to be taken. Ahead of that, I would expect to see things begin to discount what's likely to happen, if you like, in that sense. And on that basis, I would expect gold to move higher. I don't think I would tie gold in too closely with the interest rate story, other than a cut in interest rates is obviously good for gold because it undermines the pricing power of the dollar. Because what we're looking at is not gold going up so much, we're looking at the dollar going down. And there's no doubt, if you look at the dollar's trade weighted index on the chart, it's a pretty bearish scene. So I think it's really how the dollar behaves, if you like, over this that's going to determine the outlook for gold. And as far as the investment strategists are concerned, when they start to look at this, worries of stagflation, I think, are going to mount and mount and mount. And, so in other words, you're going to get the job losses. I mean, we've known, for goodness sake, we've known that the US economy is not growing. I mean, if you take out the budget deficit out of GDP, you end up with the private sector plus obviously government spending, but funded government spending, actually contracting. And it's been like that for the last couple of years. So there's no way the US economy has been growing. And I just don't see that changing. We've got no growth, in fact, negative growth, if you like, in terms of the private sector, taking that deficit, the budget deficit out of it. No, I mean, it's a very distorted picture. I see no reason at all why you should not get out of credit and get into real money, which is gold. And I think people will increasingly take that view over the rest of the year.
No, absolutely. Maybe coming back to the jobs report real quick, Alasdair, before we go down the dollar and the bond route as well. The jobs report sort of highlighted that the US, and you hinted at it as well, is drifting towards a recession. That the warning signs are there, and that's maybe why the enragement perhaps happened as well, and maybe led to the firings. Like, should we use the R word again this fall? Like, does it become fashionable again? We haven't used it pretty much since March, April. So is it back on the agenda?
Well, quite frankly, I don't think it was ever off my agenda. It's definitely there. And not only that, but the conditions that we have today are, if you like, a complete replica of 1929. You've got a credit bubble. And the thing about a credit bubble is we all love it. We all think this is wonderful. We all think we're getting it right. We're making money and all the rest of it. But without realizing that actually what's happening is that credit is being funneled into financial assets, keeping them buoyed up. And it's a credit bubble. And then taking the 1929 example even further, we had Smoot-Hawley Tariff Act 1930. At that time, it was beginning to be discussed in Congress in 1929 before it was enacted in 1930. And what have we got today? We have got an even larger credit bubble. And at the same time, we've got Smoot-Hawley Mark II with a capricious president running around saying this is the most beautiful thing I've ever done. Make America great again, shut everybody else down. But he is destroying the US economy. I mean, can't someone just grab him and tell him what the hell he's doing? It's just extraordinary. I mean, and that 1929 thing should be taken very seriously because, that combination is catastrophic for portfolios. It's catastrophic for wealth, for personal wealth. I don't think we're in the situation really where, with the economy tanking, with an asset bubble about to burst, with all these tariffs disrupting everything. I mean, not just America, but globally, we are going to see, I think, a real crisis in financial values, a crisis in the dollar. I mean, the foreigners own about $40 trillion and underlying financial assets. Are they going to hang around in a bear market? No, I don't think they will. This is not good. And so where do you get out? I mean, basically, you do what you can to try and preserve your wealth, not increase it, preserve it. And the only way you do that is to get into real legal money without counterparty risk, corporeal money, which is gold. And silver, maybe.
No, absolutely.
Silver is maybe
we'll get to silver.
Way into it.
We'll get to silver because it's the gateway drug to gold, I guess. But as a response to now the jobs report as well, as you started talking about the dollar, of course, dropping, the DXY is back down to 98.7 or so as we speak, Alasdair. But also bond yields have been dropping, which is a bit of an interesting, let's call it dilemma, because you've been calling for higher bond yields since we started talking years ago, Alasdair.
Yeah.
And now, bond yields are falling as a reaction, maybe expecting lower borrowing costs, safe haven investments. I'm not sure. What do you make of that? Is that delaying your 1929 scenario?
No, I mean, the problem, I think, Kai, is that the average portfolio manager has been taught Keynesian economics, which is a load of rubbish. He's got to get a bit more fundamental about what's going on. And I mean, all we have got, and this is the importance of selling in May and going away. You don't necessarily sell things, but basically, you just freeze what you've got, go away. You freeze what you've got on the basis that you think it's going to be safe for 2 or 3 months while you go on holiday and play around with, I don't know, whatever you do. And when you come back, you consider it seriously. So, I mean, this drift back in bond yields, I think, is quite normal under these circumstances. And this is why I think when people return and they actually look at the situation, begin to understand that you've got this awful combination of a gathering recession and rising prices, then they can see that the purchasing power of their currency is deteriorating. And not only that, but policy will make it deteriorate even more rapidly. So I would expect to see bond yields begin to rise in the autumn. And I think they will rise very, very sharply. I mean, basically, what we're looking at, Kai, is the death throes of the fiat currency system. It's been going, well, almost exactly 54 years to the day. So, that's a pretty good run, I think, of the fiat currency system. It destroys all our wealth. I mean, we think we're wealthy because we've got more dollars, more pounds, more euros, whatever, but they buy less. I mean, they really do. I mean, look at the dollar. I mean, that was 35 to the ounce, and now we're nearly 100 times that, which means that a 19 measured in gold, which, as I say, is real money, and I must emphasize, we're talking about the difference between real money and credit. Measured in gold, basically, the dollar has lost 99% of its value. Are we 99% richer? We may be sort of somewhere towards it in dollars if we've been very clever in managing our portfolios. But very few of us will have made over, nearly 100 times our money, if you like, over that period.
I was going to say every kid's dream is to become a millionaire, but you might have to add a couple zeros to that statement nowadays. Like,
it
what's
really
the next
meant
one? Like millionaire, centillionaire? Like, what is it?
It really meant something when I was a kid, but now, I mean, I think the youngsters growing up sort of wanting to be ambitious, I think they got to sort of raise their game a bit and talk in billions, not millions.
I was going to say, I was listening to an audio play from the 60s, and it was just like, yeah, I just made my 10th million. I was like, oh, what? That must have been a lot of money back then.
Well, it was, but I mean, if you look at national accounts, I mean, this is another indication of it. You look at GDP and all the rest of it, and you see how much it has increased. It hasn't increased so much about economic activity. It's more because of the loss of the purchasing power of the currency. I mean, you can't really make long-term comparisons without taking that into account, and nobody does.
No.
But it's not good. No, it really is not good. And I think, as I say, I think you should note, and your viewers should note, that we're coming to the end of the fiat currency system. And then ask yourselves, how do we evolve from that towards sound money? And the answer is extremely difficult, because all the malinvestments and all the rest of it have got to be dealt with. And I think initially, the way they're dealt with is by further debasement of the currencies. It's the only way it can be done.
Now, I was just reading in the UK, I think they need to raise, or the UK needs to raise $50 billion more in tax, or pounds in taxes, just to house. I think it came out today or so. Like, that's not feasible. How is that possible to do?
Well, of course, I mean, we are in the same bind as virtually all the other G7. Raising taxes basically is producing diminishing returns. I mean, socialists don't believe in the Laffer curve, but I think they're finding out the hard way that it actually does exist. All our millionaires and billionaires, we've got a huge number of them, they're all disappearing to Dubai and Milan and wherever. And I mean, we are very reliant on the rich, basically, to pay taxes. I mean, it's, one of the most common stats being bandied around is that the top 1% of earners in the UK pay 30% of the income tax. And they're basically going. And the other thing The other thing they're doing is they're changing their habits so they don't have to pay so much tax. I mean, it really, I think, I mean, there's the idea that the gap is 50 billion, I think is actually could turn out to be an underestimate, if you like. The problem that the Chancellor faces is that she can't cut welfare costs. I mean, the Parliamentary Labour Party is elected to protect welfare and increase the amount of welfare. And a large portion of the opposition on the Conservative benches also take the same view. You know, we're here to improve things for our constituents. What are our constituents' problems? Well, they're being squeezed because, you know, their pounds buy less and all the rest of it. And, you know, their welfare payments don't go up. And, you know, so, you know, we need higher pensions. We need this, we need that. I mean, it's all gimme, 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 gimme. That is what a, you know, what a member of parliament is now elected to do. So when the government of the day faces reality and finds, oh dear, we have got to cut spending, you know, it's chucked out of parliament. They can't do it. And then you've got Keir Starmer running around and saying we're going to spend another 5% of GDP over the next 4 years or something on defence because of those nasty Ruskies. I mean, you know, where's it going to come from? Out of thin air. Look,
Money
these
printer.
governments, they all have the same problem. And this is why I say this is the end of the fiat currency system. It's coming to an end. And it's going to be very painful for those who have relied on it.
It will be. And maybe one, what do you call it? One nail in the coffin might be the tariff discussion. You touched on it. I just want to elaborate on that because there's a tariff deadline coming up. The U.S.-China tariff truce is ending in about 6 days as we record this, Alasdair. What do you make of this? Like, is it good? Is there going to be an extension? What are the markets doing with it? What are your expectations?
Well, I mean, the markets are bemused. I think as far as the Chinese are concerned, you know, they know that they can't rely on America. They know that Trump says one thing one day and another thing the next day. So the idea that the deadline and forget it. I mean, as far as the Chinese are concerned, this is just a whole load of nonsense. And so they're planning to go ahead without America. And they can. They've got the Shanghai Cooperation Organization, which basically is the majority of Asia. They've also got the ASEAN partners, you know, all around them in that part of Asia, you know, sort of Thailand and Malaysia and Indonesia and all the rest of it, all those nations, which have big Chinese diaspora and therefore are sympathetic to trading relations. They will also, in my view, bring in South Korea and also Japan. And on top of that, you've got the existing members of BRICS, and you've got you know, what's called the global south, the ones who at the moment are frightened of America, but want to join BRICS as soon as they see American power diminish a bit. I mean, the world is splitting into two. And, you know, we as American allies are in the minority. And here we are trying to push the majority around. What happens is they say, well, we don't need you. And I think that is what's going to happen. So, I mean, this is another thing. Once markets begin to realize this, then, you know, capital reallocation, the reallocation of global capital is going to become a major issue for America. In the past, they've dealt with this. And in the case of China, they dealt with this by, if you like, calling them out as being, you know, ruthless against Uyghurs and all this sort of stuff. And they tried, according to one of the heads of intelligence, of army intelligence in China, and this is publicly reported, they reckon that the Americans were behind the 2014 Hong Kong student riots. And, you know, why? They've been trying to destabilize China. I mean, attacking Huawei was another, you know, quite simple American operation. Every time the Americans try and do something, I mean, I have this image of President Xi, you know, who doesn't give anything away. He just sort of stands there, smiles slightly like that, and lets the Americans make all the mistakes. It's Sun Tzu, if you like. This guy knows what he's doing, and you have Trump running around like a stampeding herd of elephants in the global economy, thinking that he's doing good for America. No, he's not. He's killing America.
So, Alasdair, based on what you've mentioned, like what is priced into the gold price right now, which takes us a bit to the geopolitical discussion. Like, how geopolitical is the gold price right now? Can you elaborate on that?
Yeah, well, it is obviously geopolitical because if nothing else, central banks have been accumulating it. They have, in effect, they've been selling dollars and getting into real money. So, yeah, it is geopolitical. We know, at least I know, we don't have official confirmation, but I think it's generally accepted that the Chinese and also the Russians have a lot more gold than they say they have. They can go onto a gold standard to protect their own currencies from the end of the fiat currency era. So, yeah, I mean, I think this is the background for gold. I mean, looking at it, gold has risen more than quite a lot of the things that you would expect to rise over time with it. I did an analysis a little while ago of pricing base metals in gold. And I found that from the prices in the year 1900, so we're going back 125 years, gold is now less than 20%. Sorry, not gold. Base metals, a basket of base metals is now less than 20% of the values at that time. Now, the reason I say this is that we do know over long periods of time that the purchasing power of gold is stable. So in other words, while we can't say that, a 80% discount, if you like, in terms of value is an accurate measure of anything, what we can say is that gold is ahead of the game relative to precious metals. And I suspect that's also the case with other commodities. I think this tells us two things. It tells us that a lot of commodities have been left behind, and I would expect to see commodity prices measured in fiat currencies and also gold tending to rise over the next 4 or 5 years. So I think that's the first implication. The second implication is that gold itself, in terms of its own value, may well be getting a little bit ahead of the commodity game. So it's not just commodities being undervalued, but perhaps gold being slightly overvalued. I would expect to see that measured in fiat currencies. So yes, gold, I think, is a little bit ahead of the game, if you like. But then it is, in terms of its value relative to fiat currencies, it's bound to reflect the prospects for fiat currencies. So I think it's quite reasonable to suggest that the current level is fine in that context. And maybe if things, negative things materialize on the economic and political and geopolitical fronts, then gold is still underpriced. And the interesting thing is, if you look at the technical position in the market, we're just completing what Edwards and McGee, the people who wrote the definitive work on Dow theory all those years ago, call a pennant. And the point about a pennant is that the move in gives you a forecast for the move out once you break out on the upside of the pennant. And so we're looking at adding probably a minimum of $900 once gold breaks 3,440, which is not too far above the current level. Once it breaks up above that, we could run another $900 to 4,400-ish, let's say, in a similar space of time that the move in took, which takes us to that level at the end of this year. So given the technical situation, I think this indicates that there is going to be a developing problem in fiat currencies. And I can see exactly what that is. The asset bubble popping. I mean, just imagine what happens when asset bubbles pop. I mean, basically, all the collateral held by banks against their loans. And if you look at the margin loans in the system, supporting financial asset prices and particularly stock market prices. That's gone over $1 trillion now. That is at an all-time record. So, I mean, this is a bubble which, when it pops, is going to create an awful lot of collateral damage. And what does the Fed do in that case, the Fed and the Treasury? Well, basically, they start rescuing zombies. And maybe, if only to protect the banking system. So, with that sort of trouble in store, I can see gold going up to $4,500 quite easily by the end of this year. But I mean, it is reliant on those things developing. But, any financial historian can see the prospects of that developing if they really look for it. And again, I go back to 1929, credit bubble plus Smoot-Hawley Tariff Act, Mark II this time. And, this Trump's tariffs are even more destabilizing than Smoot-Hawley was by a long chalk.
This seems like a natural end to the conversation, Alasdair, but I do have one last question that popped into my mind earlier. Is like, what do you think happens to the gold price if China reveals its true ownership of gold? What do you think will happen?
Well, it would drive it without a doubt. It would drive fiat currencies down. Let's put it that way. I can't see. I mean, the purpose of making an announcement such as that, I would have thought, is a precursor to protecting the currency by putting it on a gold standard. They can do it. Of that, I feel quite confident. The Russians can do too, and I'm sure the Russians have already considered doing this. But the Chinese have probably encouraged Putin to stay his hand on this issue. So, it's a situation really where, so long as governments and central banks can print money, ad infinitum, then they're going to continue to do it until they have to face the reality. So China making that announcement, I think, would be the first step towards a reality. But I mean, they're moving in that direction already, because the Shanghai Gold Exchange is opening vaults in Hong Kong and also Saudi Arabia. And I'm sure there will be other vaults, around, particularly around the Far Eastern region. I mean, I would expect to see them in Thailand. I would expect to see them in Indonesia, Malaysia, maybe Singapore as well. That region is going to go on a gold standard, I think, without a doubt. It's just a question of when. It's all part of protecting yourself from the follies of the West, and particularly the aggressive follies of America, which weaponized its dollars. Big mistake.
Just to take that one step further, Alasdair, would that automatically make it the next world reserve currency if they put it on the gold standard?
I think it's quite likely. I think that's the way it's going to go, because the story at the moment, as far as BRICS is concerned, and also the Shanghai Cooperation Organization, is that settlement will be occurring in their own currencies. Now, I think that their own currencies, it's a question of individual trade agreements. If you're importing, say, copper from Indonesia into China, that's easy enough. You take Chinese yuan. But if you're selling copper into Pakistan, do you want to take their currency? I think the answer is probably you would agree to take Chinese yuan. So I think that's the way it's going to work. And then, having effectively rejected, the weaker fiat currencies, I think what then happens is that the yuan becomes, if you like, the replacement for the dollar, and they will need to secure the purchasing power of the yuan in order for it to replace the dollar. But they're not going to do that before they really have to, because to do that before they really have to, I mean, that could end up, particularly with this administration in America, it could end up World War III easily, because it's so destructive of America.
And on that bombshell, Alasdair, we got to wrap this up. Really appreciate you joining us. Where can we send our audience to follow more of your work, Alasdair?
Well, I run my own Substack, and I've got quite a few European continental paid subscribers, I'm glad to say. It's Macleod Finance Substack, and it's alasdairmacleod.substack.com. The more the merrier. And I write about credit, money, precious metals, economics, geopolitics. I try and clarify things, if you like, in such a way that the normal, average, non-expert can get a grasp of what's going on.
Exactly. That's why I love chatting with you, Alasdair. You make it seem easy.
Oh,
fantastic.
That's the
Alasdair,
objective anyway.
Absolutely. No, Alasdair, really appreciate you coming on, and everybody else. Thanks so much for tuning in to Soar Financially. Much appreciate your support. Don't forget to hit that like and subscribe button and let us know what you think. When is China going to tip their hand? When are they going to show us how much the gold they really own? And what do you think their motivation will be to do so? Really looking forward to hearing from you. Put that down below, and we'll be back with lots more here from Soar Financially. Take care out there.